philsgang.com.
Whoa!
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye.
And welcome to my podcast. Today is Monday, October 20th. Well, okay, so while President Trump is making peace throughout the world, there is a problem back home. And everyone knows it. If you go shopping, if you go to a supermarket and you buy beef, or the prices are high, things are still high. So, and he's got to start focusing more on that, because what's happening, and this is not good, is that his ratings are starting to come down. And that's the last thing he wants. So his approval rating as to how the economy is working has dropped from 43% to 36%. And 68% of Americans, view the economy, as negative. And more people do, because it is negative. Why we have all these tariffs and all the money coming in, he needs to explain better. That's not going to give us a break right away. Down the road, maybe 10 years from now, 5 years from now, but not now. And we have a dope running the Federal Reserve. I mean, they don't know what they're doing. And the only way they're keeping this, the stock market going, they're trying to use the stock market to mask the economy. And the more we hear out of Washington and the administration is, gee, the economy's doing well, it's terrific. But it wouldn't be, if that is the case, then why is it that 68% of Americans are viewing the economy negative? Because they go shopping. Now, yes, you've got to give Trump credit a lot. He's only been in office 8 months, number one. Number two, he's done a tremendous amount of good in 8 months. We're not taking that away from him. And everybody's really proud of what he's done over in Israel and all this. I mean, believe me. But when it comes to, someone's working 2 jobs, a job and a half, both the wife and husband working, they're struggling, and they don't see a break. They can't catch a break. They're not happy. And as much as everyone's thrilled with all the wars he's stopping, it doesn't help, the individuals at home. Now, the biggest problem we're having is, again, half of our workforce are illegal immigrants. As I said last week when we talked about this, we're not talking about illegals that go around raping and killing and stealing. No. We're talking about those people. They've come over here years and years ago with their parents, and now they're adults, now they're working, but they're just illegal. So we just shipped 2 million last week out of the country. The problem for the companies is, how are they going to replace them? They got to find another illegal. It's going to be hard to do. If they can't replace them, then what's going to happen is their earnings are going to go down, the stock market's going to go down, and then spending goes down. Then it's just a vicious cycle. So Powell, who's a dope, what do you think he's going to do? What he always does, expands the money supply. That's how they've been keeping the stock market up. Just keep expanding the money supply. And, we know banks are able to, and they do it thinking, well, gee, I'm going to increase the money supply. I'm going to expand, Fed said, well, I'm going to expand our balance sheet. And, but the problem is, when they do the money supply increase, most of the money is not going to individuals or small businesses. Most of the money goes to CEOs who keep doing stock buybacks to keep moving the market up. Now, this afternoon we had a nice rally. The Dow's up over 500 points. But when you break it down, it's only one stock, Apple. Apple. Now remember, Apple, every once in a while they'll come out with an announcement because remember, Apple is a retail tech company, okay? They're not cloud providers. They're retail. You know what they do? They sell tablets and watches and all this stuff. And every once in a while they get a big break and they sell a lot of whatever and they make the announcement and the stock goes up, then all the other stocks go up. And all of this, masks what's really going on, and you get everybody buying the same stock again, everybody jumping and buying Apple, then a few other stocks start going up, and they start giving it all back again. But my point is, the way they keep the stock going up is they keep on increasing the money supply. That's what all these guys are doing. So we don't have a real healthy economy. And when you expand the money supply, this guy Powell, it creates, I remember we had the crash in 2008, 2009, and they expanded the money supply like crazy, right? Stocks went up. The economic growth went up about 10%, but it wasn't all good. It wasn't all good. We had inflation, employment started to go down. Remember, when you have increased money supply, it sounds great. Hey, they're increasing the money supply. Rates are going to go down. There's going to be more money available. But it also leads to higher borrowing costs. Okay, at some point it leads to, it's not, oh gee, we're going to increase the money supply, then the rates start going down. But in the end, an increased money supply will always lead to higher borrowing costs. Okay, and that reduces consumer spending. Now, yes, when they increase the money supply and companies buy their own shares back, and in the beginning, everybody's happy, and there's and the banks have some money to reduce rates and try to get you to consume, but that doesn't last long, because as I said, most of the money goes to CEOs to buy their own shares, so you don't always get the advantage of rate cuts being stable and staying there. They start increasing. The increase in money supply, as I say, is always the amount of money available for you and me to spend in the economy. And the circulation of this money is managed by a dope, the head of the Federal Reserve. Now, in the beginning, as I just said, an increase in money supply does create lower interest rates. Interest rates do drop in the beginning. And yes, more money is available for us to borrow from the banks. But a lot of times they make money available to borrow, but people shouldn't be borrowing more money because they are, the consumer, think about it, they're struggling. Home-related expenses. Think about the home-related expenses. I was looking at this weekend. Increased from 30% to 48%, 50%. That's crazy. And at the same time, about 35% of people that are employed are only making $15 an hour. I'm not talking about the illegals. So this increasing the money supply, yes, it cuts rates for a while and everything looks good, but people get into more and more debt. And what's happened is people are struggling because of this massive increase in money supply since 2009. And when you look at it, and I'll put up the chart, you may just find this interesting. I don't know. Let me see if I can find the damn thing. Okay, where is it? Let's see, increased money supply. M2, here we go. Look at this. Look how they increased the money supply from 2009. This is not good. In 2009, okay, in May, there was $8 trillion, okay, in money supply. And look where it's gone today. $22 trillion in money supply. $22 trillion. So it's so, and they're doing this saying, well, then we're going to increase the money supply. We'll give it to the CEOs. They'll raise their stock prices up, and we'll make money available for the consumer. But wait a minute. We have an historic, and this is what they're going to do again. They're talking about doing this again. And so right now we have historic delinquencies in auto and credit cards and home mortgages. We have a record household debt of $18 trillion. That's $105,000 per person. Per person. Mortgage debts, $13 trillion. Credit card debt, these are all records. $13 trillion. Credit card debt, $1.2 trillion. I remember when it was like $800 billion. Okay. Auto debt, 1.6 trillion. Savings are down to nothing. It used to be 7%. It's 2.3%. Nobody can save anymore. They can't, especially if they got medical bills. And what's really amazing is record housing affordability gap. 57%. Okay, medium. Think about it. We have a gap of 57%. What does that mean? A medium price home in this country today is $462,000. That's insane, right? $462,000, and that's $3,600 a month. Income that you need to buy a home at $462,000, which is a median price home, average price. You need an income of $125,000. But the majority of people in this country are making $65,000 to $70,000. So let's say you're making $70,000. That's a gap of 57%. What are you, nuts? So the housing affordability gap is at 57%. People don't have a chance to get a starter home. You get out of college, want to get married, you can't buy a home. So all this increase in money supply that started in 2009 is all BS. It didn't help anybody. It didn't help us. And they're still doing it. And they're going to do it again. You want to know why? Because they want to keep stocks going up. And remember, the only people that are making money in the stocks are the top 10% who control 85% of the stocks. So when they say, yeah, well, we're going to increase the money supply and the stock market go up, people get wealthy. No. Very few people are in the stock market. On average, 85 to 90% of the stocks traded every day is by someone, is part of that top 10 percentile. The top 1% of that 10% controls about 20% of the stocks. So it's not like when they increase money supply, everybody's in the stock market. 401ks, you're not making money. You're screwed. Your 401k's up 5% when the stock market, the S&P's up over 30%, 35%. You're getting screwed. So the Federal Reserve is talking about increasing the money supply again. That's the worst thing they could do. They got to stop doing that. And again, why are they doing it? Because they want to put more money into the banks, and the banks will take that money and loan it to CEOs to buy their own shares. Now, an increase in paper money reduces the value of the dollar. Our dollar's getting killed. Have you seen the dollar? My God. Now, when the dollar goes down, remember, that's good for gold, good for commodities. And by the way, if you're in GLD or GDX, don't panic. Okay, don't panic that gold prices are starting to come down a bit. Now, I've told my gang members this for the last 4 weeks. They said, you're going to see about a 5 to 7% pullback in the miners. Okay, these miner stocks, which we did fantastic, they're up 92%. But I said, you're going to see a pullback. But just because it came down, okay, on Friday, people started to panic, but no, don't sell your gold yet. Don't sell your miners, for God's sakes. Wait until we get a sell signal. Remember the charts we design, our charts will give you a sell signal. Nobody else's charts give you a sell signal. It will turn red and give you a sell signal. So there's no sell signal on GDX. So when they pull back, same thing that happened, listen to this. When they pulled back in September 18th, There's no sell signal. People dumped. They dumped their stocks, and the stocks, gold, GDX, our miners went to a low of $67. Now, can you imagine? 67. They missed the whole run to $80 to $85. And another one happened. You go back to October 2nd, and gold pulled back to a low of $74. People scream, get me out, get me out. And they missed the rally up to $85. Just because stocks pull back, you got to look at your chart to see if it's going to be a short or not. If it's not, you don't get out, stay in. And our chart will tell you that. We designed our charts to do that. More in a minute.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
When the stock market is volatile, how do you invest intelligently?
Hi, I'm Phil Grande at philsgang.com. There's no need for you to be panicking in a market that goes up 800 points one day, 700 points, then it goes down again. All you need is good advice, need good direction. You don't get that from your CNBC and the Fox business and all these crazy shows. You don't. Here's what you get from them. Thank you, Jim Cramer. But this is something that this really bugs me. Listen to this.
Our responsibility begins and ends with our partners and our shareholders, and that's it.
What? Their responsibility is to their partners and shareholders and not to you? Check my site out, philsgang.com.
When the stock market is up one day and down the next, you need the experience of Phil Grande at philsgang.com.
What a difference it makes in your financial life. philsgang.com. It works.
Welcome back. Learn, invest, and make profits with Phil Grande. Simply go to philsgang.com. Now, here's Phil.
And welcome back to Phil's Gang. So we're talking about the Fed is considering increasing the money supply again. And it just, they shouldn't be doing it because our consumer is in deep trouble. And the evidence here, listen to this. This is unbelievable.
This is a rational bubble that...
Have you ever seen a rational bubble?
This is a rational bubble that a lot of money is being thrown at different AI actors at the micro level because the promise is so huge. That is a good thing. That's what distinguishes us from the rest of the world. Because
oh my God. We have the biggest AI bubble, as I've told you. Every day or once a week or once a day, but very often we'll get an announcement. Oh, remember Oracle? Oh, they teamed up with OpenAI. Boom! Stock goes up 25%. Next day, another one comes in. AMD. Oh, just teamed up with OpenAI. Boom! Stock goes up. That's how they keep driving the stock market up. There's a handful of stocks. They're holding this whole market. This guy's nuts. This is one of the biggest bubbles ever. But remember, I've been telling my gang members all along, I don't see a crash coming. I don't see a crash coming for a great while. I don't see a crash coming to next year. Next year. Now, it can, and if it does, my members will know before it occurs because our our charts, the way we designed them, oh my God, all the way back in 1998, okay? And they're wonderful because they follow the money, not the BS. They follow the money. When money starts coming out, and you know when we're going to have a correction or a crash. But listen to this one here.
What I'm worried about is that high yield spreads are at historically tight levels. I'm very nervous that we're issuing pay-in-kind zero coupon bonds, which is a sign that the company doesn't have enough cash flow to service its debt. And frankly, we have this new category of private debt that doesn't have the covenant protections that regulate.
Oh, blah, blah. What the hell is he talking about? Here's what he's talking about. They're called credit spreads. I always explain these to my members. You'll hear narrow credit spread and wide credit spread. A narrow credit spread indicates there's not going to be a very low probability of a crash because people are buying more corporate low-yielding bonds, okay, than instead of the high-yielding treasuries. Now, when a credit spread is wide, okay, you hear them say credit spreads are getting wider. That means you got a high probability of a crash. All that means, all this gobbledygook, all that means with these jibber jabbers, to make it simple, they buy more. That's when you have a wide credit spread when they're buying more high yielding treasuries over the lower corporate bonds. So that's all that means, okay? Narrow, they're buying more corporate, okay? More corporate, and wide means that they're buying more treasuries, okay? They're buying more treasuries. So, but listen to this.
First of all, the fundamental story is very good. Mm-hmm. There's a broader narrative, which is we think earnings per share are going to be 13% higher next year. We are raising estimates for most of the banks.
Yeah, the banks, yeah, right. The banks, last week when the banks came out, and everybody went nuts starting to buy the banks. And I told my members, don't chase the banks. They're going to come back down, okay? So if you took a look, for example, let's see, let me give you Wells Fargo. So Wells Fargo took off, right? It went from, I think it was on Tuesday, it went from a low of $80 and some change, and then it went all the way up to a high of about, I think it was high about $87. And then what happened? It dropped all the way back down to a low of, now remember, people don't buy when it starts going up. They always buy at the very peak. They always buy at the very peak. So the majority of the people who bought this bank stock, Wells Fargo, was around, as I said, $87. And it dropped down, and they lost their money, and it dropped down to a low of $82. Now, today, people jumped in again and bought them at a high of around $88. Okay, Wells Fargo, guess what? It dropped right back down again to $85. Now, again, with my charts in the last 5, 6, 7, 10 trading days, it's been red. Your chart won't show that. Your chart will show green, red, like a Christmas tree. My chart showed, because we designed our own charts so that we're following price. I want to see the price. If money's going in, my price goes up. If money comes out, my price is going down. So last week, when they came out on Tuesday, October 13th, with all these banks, and people went nuts buying them, I said, no, they're going to lose money. Now take a look at, for example, another one was, which was it? It was, UBS, another one. So on Tuesday, okay, it took off. It had a low of around 45.93, and then it went up at a high at about 47.78, came all the way back down to a low, okay, of 45.51. Now today it's at 47.10. These banks are having a hell of a time. They're having, because why? Because of the delinquencies, okay, and foreclosures and bankruptcies. So this idea to increase the money supply now couldn't be worse, Because all they're trying to do is make sure the stock market doesn't correct between now and January. That's what they're trying to do. And the other thing they're trying to do, Wall Street, is make sure that the margin accounts, that they can keep them chock full of cash so that the tourist investor who doesn't know what he's doing will keep buying when they listen to these guys here, right? Like, for example, when you hear this guy say,
first of all, the fundamental story is very good. There's a broader narrative, which is we think earnings per share are going to be 13%.
yeah, right, where are you going to get earnings from? Where, just the tech stocks, right? Tech. The only place you get earnings is tech. Because people don't have money. They don't have any money. When you got household debt at $18 trillion, that's $105,000 per person, they're now outspending. When they got to buy an average home at $462,000 average, they got to be making $125,000. How many people make $125,000? Not many. The majority of people in this country make about $65,000 to $75,000. I'm talking about a couple, a household. So again, the Federal Reserve wants to increase the money supply, but when you really take a look at the market, you got the only thing that's really working besides gold, okay? And we've had our members take a lot of our mining stock profits, not getting out, but taking a lot of our profits. But the whole economy's been surrounded around a handful of stocks, a category of stocks, I should say. So if you look at where the money is going, okay, where all the money is going, it's going into, again, your chip providers, your cloud providers, and your stocks that support the infrastructure of the chip providers. So you got NVIDIA, AMD, Intel, those are the chip providers. You got cloud providers, Microsoft, Google, Amazon, smaller providers like IBM, Alibaba, Oracle, and then you've got two companies, Broadcom and Micron Technology, who does the support infrastructure, and that's pretty much it. Okay, now when you go, I mean that's the stock market. It's the whole stock market. If you go look at the ETFs, like look at the MAGs. They went up a little bit today. They're struggling, but again, if that's one of your stocks, you're in the MAGs. We're not going to add to our position until it gets above 65. Maybe about $66, $67. And ARK, everybody's favorite, ARK, right? Do you realize ARK? If you look at the MAGs, think about this. It peaked on October 2nd. It peaked at a high of 65.70. Today we're almost back there. But you know how many days it took to get back there? About 14 days. And when we had that big drop on October 10th, it took 2, 3, 4, 5, almost 6 days to claw back the drop. I'm talking about the MAGs. You take ARK dropped again on October 10th, and we're not even near the high of October 10th. That was at 92.45. We're at 90.18, but it took 1, 2, 3, 4, 5. This is the 6th day. What's going on? Why is it taking 6 days? It never took 6 days for these stocks to claw back their losses and go back up. So the idea of the Federal Reserve increasing the money supply is a bad idea. They want to cut rates. They want to get people consuming again. They turned around and they said, well, we're going to cut rates for corporations, and they're going to get all excited and start hiring. That's a bunch of crap. That didn't happen. You give corporations all the money that they want for nothing. They're not going to hire. They're not going to hire. Remember, when banks have more money to loan, they reduce interest rates, right? And consumers pay for these loans. And typically, the consumer, okay, finds it easier. He can go spend because it's easy to borrow money. That's the worst thing they should be doing now, is the banks making it easy for consumers to borrow when we have record household debt. record credit card debt, record auto debt. Why in the hell are they making it easier for these same people to go in and borrow to spend? It's all about the top 10% who control the stock market. The top 1% control the stock market. They control all the banks. They control everything. And so they're going to do whatever it takes to make sure this market doesn't come down. They have gotten so spoiled that we've had such a long run where the top 1% are making fortunes. Fortunes. I had some statistics. I don't know if I have time to find them. They were staggering. It was how much the top 10%, 1% were making in the stock market, okay, compared, again, to the bottom 50%. I don't have time to catch them for you today, but I'll do it for tomorrow. It's crazy. It's crazy. We got a stock market. It's the most overvalued ever in history. It has the worst concentration of money, few stocks, the worst breadth in history, the worst amount of stock buybacks. My God, the stock buybacks are nuts. Of course, stocks go up when Apple over 10 years, okay, bought $735 billion, okay, billion. In the first quarter of 2025, they bought $26 billion of their own shares. So the point is, the Federal Reserve, their job, remember, their job is to make sure, okay, everything is okay, right? I mean, their goal, the Fed, is to promote maximum employment, stable prices, moderate long-term interest rates. What a bunch of crap that is. They are not good at doing any of that. The Fed is always wrong. It's never right. And the idea that they're going to come in and start doing increased money supply is nuts. Then they're going to panic and they're going to turn around. And what they're going to do is the opposite. Instead of increased money supply, they're going to turn around and take the supply back out, going to start reducing it. Because once they see how they're destroying their own economy, I mean, remember, an increase in money supply is negative, has many negative effects on our economy. It causes the value of the dollar to decline. My God, we don't need more of our dollar declining. I mean, look at the dollars getting slaughtered. And I mean, it's terrible. The dollar's getting so bad. And an increase in money supply also gives us negative effects, big ones on our economy. Not only does the value of the dollar tank, it makes imported goods so expensive. So when people go into Home Depot and they go to Lowe's and they go to Walmart, and they're stunned at the prices they're paying because prices keep going up. Why? Because look at our dollar. Look at our dollar. Our dollar is so bad right now. Every time our dollar tanks, you go to Walmart, you'll see things much higher. Join my gang. Get my stock picks. Learn how to trade properly, especially shorting.
Listening to Phil's Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.
It's up to